When you get on a plane, you never think about that unlikely event. The crypto world is full of turbulence and a crash is more likely than in an airplane scenario. Something which can start as a small dip can quickly become a landslide. And when that happens, prices will go crazy, the exchanges will fail, and all the wallets will go into the maintenance mode. Investing without any kind of risk protection is pure gambling. But I know you are intelligent, the people who are watching this. Even if your strategy is to buy and hold forever, you would have thought about some exit plan in your mind. Although no one can accurately predict when the markets will fall, there are some factors that can signal the possibility. And in this video, I'll show you how to read those signs, prepare an exit plan, and to execute it perfectly. Keep in mind that I'm not a crypto expert and none of this is meant to be taken as financial advice. Feel free to use this information, but make your own decisions. All good things don't stay that way forever. In an ideal world, the price of crypto will rise organically, reaching new highs, and we would never have to sell. My personal opinion is that the best way to survive a Bitcoin bear market is to hold and patiently wait out the storm. Holding, or in crypto lingo, hodling, simply works and is 99.9% safe for Bitcoin. But this cannot be said for other tokens out there. A good trader should know when to buy, when to hold, and most importantly, when to sell. When the odds are against us, we should be able to identify it immediately and get out early. And that's the exact reason why having an exit strategy is very important. When you hear some terrible news from the crypto world or see a sudden drop in one of the tokens you hold, the first and the most important thing you can do is not to panic. I know crypto markets could be brutal and the swings are not for the weak-hearted. But making emotional decisions, especially at times like this, rarely do anything good. So stay calm and analyze if the drop is due to a temporary event or something long-term. For example, China banning the Bitcoin mining was a one-time event that adversely affected the price of Bitcoin. But then Bitcoin pushed back and recovered. Crypto is a global commodity, and these isolated local events, even though they can make some short-term fluctuations, they rarely last for long. But if you see signs of a risk that can persist or even get worse, then it's time to dig deeper. When the price starts to drop, the first metric to look out for is where are the 50 and the 200-day simple moving averages. The 50-day simple moving average is a line that represents the daily closing prices of a security averaged over the past 50 days. And similarly, 200-day simple moving average is the average closing price over the last 200 days. In the case of a crypto crash, red flags should go up if assets are seeing high selling volume and the price is closing below either of these lines consistently. Now let's open a Bitcoin price chart on TradingView and add the 50 and 200-day simple moving averages along with the daily selling volume. If you are unfamiliar with the candlestick trading charts, the red lines indicate a price drop and the green line indicates a price gain. And this section below shows the buying selling volume. Red indicates selling pressure and green indicates more buying. When we look at the chart, we see there was a crash on February 2020 and there was a more than average selling volume at this point. At the same time, the price closed below the 50-day moving average and almost touched the 200-day moving average. This was the start of COVID-19 pandemic and the market crashed within a few days. A similar pattern can also be seen for Ethereum before the crash that happened at the beginning of this year. And if you look at the trading patterns at the end of the last year, Ethereum closed below the 50-day moving average several times before crashing. You see how the price moved across the 15-day moving average multiple times, and we can also see the high selling volumes these days. That wasn't good at all. Then comes a drop below the 200-day simple moving average and then the crash. This is your first indication that something is wrong, but you don't have to start selling yet, because the markets can bounce back even after these signs. But once we see these signs, then it's time to prepare and set our exit points. And to do that, we need to know two concepts from trading: the idea of support and resistance levels. Personally, I don't do short-term trading. I think the crypto markets are too risky to trade without having the necessary expertise. And also I am in it for the long run. But the data is there for everyone to see and take actions. Support and resistance are two of the major concepts in trading because they indicate when a trend may change the direction. You can think of it like this. A support level is a floor for the trading prices and resistance is a ceiling. In any market, prices go down because there are more sellers than buyers. However, as the prices become increasingly lower, it gets to a point where the buyers will become interested again. This point at which the demand starts to kick in and the trend reverses in the upward direction is called the supporting level. Once the price drops and reaches a previous support level, two things can happen. The support level will be tested. In that case, it will either hold and the price will bounce back up, or the support level will break and the price will likely continue lower to the next support level. But in any case, those are the action points where traders make the most decisions to buy or sell. I will shortly explain how we can use the support level to set our exit points. But before that, we have to talk about the trend lines. Trend lines are created by connecting either the support levels or the resistance levels. Simply speaking, trend line is just a line that shows you the trend. You can ideally draw a trend line at any time frame connecting any number of points, but a trend line that connects the most number of peak points and works with the recent data is most reliable to make a prediction. And an ideal point to cash out your holdings would be when the price repeatedly breaks the trend lines and the corresponding support levels. Now let's check this theory with the recent Terra Luna crash. When we look at the price charts, we can observe all the above set indicators. The token price moved around the 50-day simple moving average with high selling volumes before falling below the 200-day simple moving average. To find where we could have exited and avoided total losses, we should see our supporting levels and draw the trend lines. We can connect the low peaks and draw a supporting line here and another one here. At these points, we could have considered selling the coins. They are below the moving averages, they are below the trend lines, and they are below the recent supporting levels. I know selling here would be a 40 to 50% loss from this peak, but it is always better to limit your risk and get out with some profit than end up with nothing or a substantial loss. Once you identify the exit points, you need to have an exit strategy. When a crash happens, things can move so fast that you might never have enough time to respond. So it's crucial to automate the exit using limit orders. Limit orders are the points at which you pre-plan the sale of your crypto at a specific price. This could be based on the trend lines or the support levels that we discussed earlier, or it could also change based on your personal investment goals. For example, let's say you bought some Bitcoin for $25,000, and when the prices starts to go down, after considering the amount of losses you can afford, you decide that you will sell your Bitcoin if the price hits $15,000. So you would set a limit order for $15,000, and when the price hits this value, a limit order will be executed automatically and your BTC will be sold even if you are sleeping. But what happens if the prices climb back to 17,000 after dipping to 14,000? In that case, selling all your crypto at 15k seems to be a bad idea. But luckily, there is a better way to handle this. Instead of selling all your tokens in one shot, do that in stages. If you own one BTC, instead of selling your whole BTC at 15k, divide it up into 5 parts and sell them at different prices. For example, sell 0.2 BTC at 15k, another 0.2 BTC at 14k, then at 13k, 12k and 11k. This is called dollar cost averaging out of the market. It is one of the best strategies while purchasing any cryptocurrency and is also an ideal option while exiting the market. This way, you are selling out your portfolio, and in the meantime, if the market recovers, you will still have some coins left to make use of the increased prices. Even though all these charts and metrics could look scary to someone who is new to the market, this is not rocket science. In any trade, there are only two factors involved: greed and fear. When people feel greedy, they buy, and when they sense fear, they sell. And if we can read into it, we can make some accurate predictions. We simply cannot control how the market behaves, but we can control our own actions. The only thing we can do is to analyze the data we have and then make decisions to the best of our abilities. And if you are someone who is planning to hold your crypto forever and never sell it, then it would be a wiser choice to move your crypto to a personal wallet and avoid leaving it on the exchange. Like they say, not your keys, not your coins. In the event of a sudden crash, billions of dollars would be wiped out from the market, which may cause some exchanges to run out of money and become insolvent. I personally use the Ledger Nano X hardware wallet to store my crypto. Although I have to be careful with the private keys and there is an extra step to make a trade, I trust myself than any of the crypto exchanges. You can watch these videos to know more about the Ledger Nano X and how to safely store crypto on a hardware wallet. Take advantage of the opportunities when they present themselves. Courage is not the absence of fear, but the ability to act despite it. If you like this video and want to see more similar content, think of subscribing to the channel. Until I see you in another video, ciao.